They wanted a silent night. The bankers on Wall Street wanted to go home early. They wanted to close their books, drink their eggnog, and forget about the silver market until January. But the market had other plans. Today is Wednesday, December 24th, Christmas Eve. Usually, this is the quietest trading day of the year. Volume is low, desks are empty, nothing happens. But today, everything happened. Look at your screen. Silver is trading at $7,242. That is up nearly $4 in a single session. That is a move of over 5.6%. This isn't a rally. This is a massacre. This is the sound of the commercial bank surrendering. They tried to hold the line at $70. They failed. They tried to hold the line at $71. They failed. And now, hours before the market closes for the holiday, they are panic buying everything in sight to get flat before Christmas. And it isn't just silver. Gold has officially hit $4,500. The currency is breaking. The suppression is failing. And you are watching the greatest wealth transfer in history happen in real time. In this urgent holiday market update, we are going to break down exactly what just happened. We are going to explain why the banks were forced to cover their shorts today, of all days. We are going to analyze the gold signal. Why $4,500 gold guarantees that silver has to go higher. And we are going to tell you what to expect when the markets reopen after Christmas. The gift has been delivered. The price is $7,242, and the squeeze is just getting started. Why today? Why would the price explode on Christmas Eve when nobody is supposed to be trading? Because of risk management. Imagine you are a risk manager at a major bank. You are short millions of ounces of silver. The price just broke $70 yesterday. You are underwater, now you're facing a holiday. The markets will be closed. But the world keeps turning. News can break. Geopolitical events can happen. Supply chains can snap. If you go into the Christmas break holding a massive short position and bad news hits, you could wake up on Friday morning bankrupt. The risk is too high. So the risk manager taps the trader on the shoulder and says, "Get me out. I don't care about the price. I want to be flat for Christmas." This is a forced liquidation. They aren't buying because they like silver. They are buying because they are terrified of holding a short position while the market is closed. This buying pressure hits a thin market and the price teleports upwards. We saw a vertical move from $69 straight to $7,242. That is the air pocket we talked about. There were no sellers, only desperate banks trying to exit the building before the doors locked for the holiday. We need to address the elephant in the room, gold. In our previous videos, there was confusion about the gold price. Let's set the record straight right now. Gold is trading at $4,499.96. Essentially, $4,500. This is the signal. Gold is the master clock of the financial system. When gold hits $4,500, it is telling us that the dollar has lost significant purchasing power. It is telling us that faith in fiat currency is collapsing. Now look at silver. Silver is trading at $7,242. Let's do the math. The gold to silver ratio, $4,500 divided by 72.42. That equals roughly 62. Historically, that ratio should be much lower. In 1980, it was 17. In 2011, it was 30. Even at $72, silver is cheap relative to gold. If the ratio creates a mean reversion to 30 and gold stays at $4,500, silver would have to be $150. This is why the algorithms are buying silver today. They see gold breaking out. They see silver lagging and they are playing catch-up. The move to 7,242 is just the rubber band snapping back. Silver is trying to find its fair value relative to its big brother. How do we know this is a short squeeze and not just organic buying? The speed, organic buying, is slow. It grinds higher. A short squeeze is violent. It moves 5% in a day. When silver moves 5.6% in one session, that is the mathematical signature of short covering. It means the sellers are becoming buyers. It means the people who bet against you are now funding your profits. This is a dangerous moment for the banks. If they couldn't stop it at $70 and they couldn't stop it at $72, where's the ceiling? Is it 75? Is it 80? The pain trade is higher. The more the price rises, the more pain the remaining shorts feel. The more pain they feel, the more they have to buy. It is a feedback loop. And right now, that loop is spinning out of control. 7,242. This number changes everything. It breaks the $70 ceiling that acted as a mental block for so many investors. Now that we are solidly in the 70s, the market starts looking at $80. $80 is only 10% away. In a market moving 5% a day, we could hit $80 by next week. This brings in the momentum chasers, the funds that only buy things that are going up. They see the chart, they see the breakout, they see the volume, and they pile in. We are moving from a contrarian trade to a momentum trade. This is the mania phase. It is scary. It is volatile, but it is incredibly profitable for those who are already positioned. So, the banks have surrendered for the day. The price is 72.4242, but the holiday has just begun. In part 2, we are going to look at the liquidity vacuum. We are going to explain why the days between Christmas and New Year are historically some of the most dangerous and explosive trading days of the year. We are going to look at the thin order books that allow prices to gap up $10 overnight. And we are going to discuss the physical disconnect that is happening right now at the bullion dealers. While the paper price is $72, can you actually buy metal? Or have the dealers close their doors for the holidays to protect their inventory? The squeeze isn't over. It is just taking a Christmas break. We are entering the thin zone. If you are just joining us, let's look at the scoreboard. The battle of Christmas Eve is over. The banks have fled the field. The price of silver is locked in at $7,242. Gold is sitting at the historic level of $4,500. The bulls have won the week. But now we enter a very strange and dangerous period of time. Traders call it the Ghost Week. It is the period between Christmas Day and New Year's Day. Most people think the markets go to sleep now. They think nothing happens until January. They are wrong. Some of the most violent, explosive financial moves in history happen during this exact week. Why? Because the adults are gone. The senior risk managers are skiing. The liquidity providers are offline. The volume is thin. In part 2, we are going to explain the liquidity vacuum. I'm going to show you why thin markets are the perfect environment for a massive price spike. We're going to look at the dealer shutdown happening right now. Why you cannot buy physical silver at the spot price anywhere in America this weekend. And we are going to discuss the risk of a Sunday night gap when the Asian markets wake up from Christmas before we do. The price is high, the volume is low. That is a recipe for fireworks. Let's walk into the vacuum. To understand why the next few days are critical, you have to understand liquidity. Imagine a crowded football stadium. If one person screams, nobody hears it. The noise is absorbed by the crowd. That is a liquid market. It takes billions of dollars to move the price because there are so many buyers and sellers. Now imagine an empty gymnasium. If one person screams, it echoes. It is deafening. That is an illiquid market. That is the market we are in right now. For the next week, the major banks will have skeleton crews manning the desks. The order book, the list of people waiting to buy and sell, will be very thin. Instead of 500 contracts sitting at $73, there might be 50. So, what happens if a whale comes in? What happens if a Japanese pension fund decides to buy silver on December 26th? They place a market order. They eat through the 50 contracts instantly. Then they hit the next price and the next because there are no sellers to stop them. The price teleports. We could see silver jump from $72 to $75 in minutes. Not because of news, but because there was nobody there to say no. This is the holiday squeeze. It is how prices grind higher on low volume. It creates a drift that catches everyone off guard when they return in January. While the paper market is thin, the physical market is closed. Go to your favorite bullion dealer website right now. You will likely see one of two things: sold out banners or holiday delay notices. They will tell you it is because of Christmas. That is true, but it is not the whole truth. The real reason they are closing shop is risk. A bullion dealer operates on thin margins. They sell you a coin and they immediately hedge it or restock it. But on Christmas weekend, the hedging market is closed. The wholesalers are closed. If they sell you a monster box of Eagles today at $75 and the price gaps to $80 on Sunday night, they cannot restock. They lose massive amounts of capital. So, the smart business move is to stop selling. They pull the inventory. They mark it out of stock. They wait until January 2nd to see where the price settles. This creates a physical lockout. You have the money, you want the silver, but you cannot buy it. The ask has disappeared. This is the ultimate sign of a squeeze. When you cannot exchange your fiat currency for metal at any price, you know the currency is broken. If you already have your stack, congratulations. If you are waiting to buy this weekend, you might be out of luck until silver hits $80. There's another force pushing us higher: the calendar. January is historically the strongest month for precious metals. Why? Because new budgets open up. Industrial companies get their new purchasing budgets for the year. Investment funds get their new allocations. Traders know this. They know that on January 2nd, a wall of money is going to hit the market. So what do? They front or run it. They buy in late December. They buy now to sell to the new buyers in January. This front running turns the last week of December into a chase. Nobody wants to be short heading into January. Nobody wants to bet against the New Year allocations. So, the path of least resistance is higher. With silver sitting at $7,242, the traders are looking at $75 as the target for the year-end close. They want to paint the chart. They want silver to be the best performing asset of 2025. And they are very close to achieving that. Now, we have to talk about the risk. The markets are closed for the holiday, but the world is not. We are watching the gold price at $4,500. This is a historic psychological barrier. If gold breaks $4,500 decisively, if it goes to $4,600 over the weekend, silver will react violently. When the futures market reopens on Sunday night, we could see a massive gap up. The pent-up pressure from the long weekend releases all at once. Shorts who held over Christmas will be liquidated instantly. This is the danger of being unallocated. If you sold at $70 hoping for a pullback and the market gaps to $74, you are left behind. You cannot chase it. This is why the hold strategy is the only safe play during a manic phase. You have to be in the seat when the music starts. So, the liquidity is gone. The dealers are closed. The traders are front-running January tour. But what about the real buyers? What about the factories? We talked about Samsung and the battery tech. But now we need to look at the year-end procurement companies like Tesla and First Solar need to secure their inventory for Q1. With the price ripping to $72, they are terrified. I'm going to explain why industrial buyers are likely negotiating off-market deals right now, desperate to lock in supply for January. And we are going to look at the mining stocks. With silver at $72, the miners are printing cash. We will look at why the mining sector might be the next catch-up trade. The holiday is quiet, but the panic is loud. Stay tuned for part 3. We are going back to the factory floor. If you are just joining us, the financial world has just received a Christmas shock. The banks have capitulated. The price of silver is $7,242. Gold is at $4,500. We have talked about the traders. We have talked about the bullion dealers. But now we need to talk about the people who actually use the metal. The industrial giants. The Teslas, the Samsungs, the Raytheons. For them, this price spike isn't a chart pattern. It is a budget crisis. Imagine you are the chief financial officer of a major solar manufacturer. You built your budget for 2026, assuming silver would be $50. Today, it is $72. Your costs just exploded. Your margins just collapsed, and you have a factory to feed in January. In part 3, we are going to look at the industrial panic. We are going to explain why companies are rushing to sign off-market deals right now, desperate to lock in supply before the price hits $100. And we are going to look at the other side of the trade, the miners, at $72 an ounce. Silver miners are making more money than they have ever made in history. And yet, their stock prices haven't caught up. The paper game is ending. The industrial reality is setting in. Let's go to the boardroom. It is December 24th. Corporate procurement departments are usually closed. But this year, phones are ringing. Industrial buyers operate on quarterly cycles. They need to secure their inventory for Q1. Usually, they buy futures contracts to hedge the price. But, as we discussed, the futures market is broken. It is volatile, it is dangerous. So they are forced to go into the physical market. They are calling refiners and saying, "We need 10 tons of silver paste delivered on January 2nd. The refiner looks at the screen. Okay, the price is 72.42 plus premium. The buyer screams, but they pay. Why do they pay? Because of fear of outage. If they wait until next week and silver gaps to $75, they look incompetent. If they wait until January and there's no silver available, they get fired. So, they are front-loading their orders. They are buying now to protect their jobs. This is massive, inelastic demand hitting a market that has no liquidity. It acts like a vacuum cleaner, sucking up every available bar before the year ends. Now, let's look at the winners, the mining companies. Let's do the math. On a primary silver miner, it cost them roughly $20 to pull an ounce of silver out of the ground. Yesterday, they were selling it for $60. That is a $40 profit. Today, they are selling it for $72. That is a $52 profit. Their costs didn't go up overnight, but their revenue did. That extra $12 flows straight to the bottom line. It is pure, free cash flow. At these prices, mining companies are printing money faster than the Fed. They are debt-free, they are cash-free. They are paying dividends. But look at their stock prices. Have they tripled? No, they are up, sure, but they are lagging the metal. This is the catch-up trade. Wall Street is slow. They don't believe the silver price will stay here, they think it is a spike. But once they realize that $72 is the new floor, they will rush into the mining stocks. We could see the mining index double in a month as investors chase the cash flow. If you own the metal, you are safe. If you own the miners, you are leveraged. And right now, the leverage is working in your favor. There is a shadow market developing. We see the COMEX price at 72.42, but that is the public price. Behind the scenes, huge deals are happening that never hit the tape. A battery maker approaches a mine in Mexico. We will buy your entire 2,286 production. We will pay you $75 flat. The miner agrees. It guarantees them a massive profit. The battery maker agrees. It guarantees them supply. What does this do to the market? It removes supply from the public exchange. That silver never reaches London. It never reaches New York. It goes straight from the mine to the factory. This shrinks the visible inventory. The COMEX vaults will continue to drain even if the price rises, because the metal is being intercepted at the source. This is why the short squeeze won't end quickly. The shorts can't cover because the metal never arrives at the warehouse. It is being hijacked by industry. We are witnessing a shift in how corporations view their balance sheets. For 20 years, companies held cash. Cash was king. Now, cash is a liability. It loses value. Silver is an asset. It gains value. CFOs are starting to ask, should we hold strategic reserves of raw materials? If Apple holds $1 billion in cash, it loses purchasing power. If Apple holds $1 billion in silver, it secures the production of iPhones for a year. We are moving from just-in-time inventory to strategic hoarding. This trend is just beginning. When major corporations start treating silver like a treasury asset, the demand will be measured in billions of ounces, not millions. And there isn't enough silver for everyone to have a hoard. So, the industry is panicked. The miners are rich, the supply is vanishing. We are heading into the final week of the year with silver at all-time highs. What happens next? What happens when the calendar flips to 2026? In Part 4, the conclusion of this series, I'm going to give you the endgame roadmap. I'm going to show you the technical targets. For the first week of January, I'm going to explain the tax-selling dynamic that might create one last buying opportunity before New Year's, and I'm going to leave you with the final verdict on how to handle your emotions when your portfolio is exploding higher. The surrender is complete. The victory is at hand, but the war for wealth preservation is never over. We are looking at the year ahead. We have reached the end of this emergency broadcast. The Christmas Eve markets are closing. The price of silver is etched in history at $7,242. Gold is at $4,500. The bank surrendered. The industry panicked. The price exploded. But, as investors, we cannot look backward. We must look forward. We are 1 week away from a new year, 2026. And the setup for January is unlike anything we have ever seen. In this final chapter, Part 4, I'm going to give you the endgame roadmap. I'm going to explain the January effect. Why the first week of the year is historically the most explosive for precious metals. I'm going to warn you about one final trap, tax loss selling. And I'm going to leave you with the strategy to navigate the transition from a squeeze to a supercycle. The year is ending with a bang, but the new year will start with a boom. Let's finish this. Why is January so important? Because the financial world hits reset. Every fund manager, every pension fund, every asset allocator gets a fresh scorecard on January 1st. They get new capital inflows from investors. They rebalance their portfolios. Imagine you are a fund manager. You just watched silver return 50% in a single month. You own 0 silver. Your clients are calling you asking why you missed the boat. What do you do on January 2nd? You buy. You have to. You need exposure. This creates a massive wave of new money hitting the market in the first week of the year. They are buying the winners of the previous year to chase performance. And right now, silver is the undisputed winner. This January effect often pushes prices significantly higher. So if you think $72 is the top, just wait until the pension funds start allocating 0.1% of their assets to silver. That tiny percentage is billions of dollars. It will hit a market that is already dry. However, before we get to January, we have to survive the last few days of December. There's a phenomenon called tax loss selling. Usually, investors sell their losers at the end of the year to offset gains for tax purposes. But in a year where everything is up, sometimes people sell their winners. Why? To lock in the gain, to pay for Christmas, to rebalance, or mining stocks that have underperformed might get dumped by funds cleaning up their books. This creates a weird dynamic. Between Christmas and New Year's Eve, we might see erratic volatility. We might see a sudden drop in mining stocks or a sharp pullback in silver to $70. Do not view this as a crash, view it as accounting. It is simply money moving around for tax reasons. It has nothing to do with fundamentals. If you see a dip in the next few days, it is likely the last buying opportunity before the January inflows begin. Be ready. The dip will be shallow and it will be bought fast. So, what is the strategy for the transition to 2026? Hold fast. The hardest thing to do in a bull market is to sit tight. You will be tempted to trade, to jump in and out, to try and time the tax selling dip. Don't do it. You risk losing your position. You risk selling at $71 and watching it gap to $75 while you sleep. The trend is powerful. The fundamentals are accelerating. The technicals are confirmed. There's no reason to sell. If you are fully allocated, enjoy the holidays, ignore the ticker. Spend time with your family. You have done the work. The market is now working for you. I want you to take a moment to appreciate this victory. For years, the silver community was mocked. We were told that silver was a dead rock, that the banks would never let it rise. We were gaslighted. Today, looking at $72, you're vindicated. You were right. The math was right. The banks were wrong. This is not just a financial win, it is a psychological win. It proves that free markets eventually overpower manipulation. Take confidence from this. Use this confidence to hold through the next leg of the journey, because $72 is not the destination. It is just the first rest stop on the road to fair value. So, here's the verdict. 2025 was the year the breakout began. 2026 will be the year of silver. We are entering. Subscribe.